Good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what we want to do is we want to wrap up the year and go over what have we seen in the markets this particular year and take a look ahead into 2022, both from a technical and fundamental perspective, to try to get a better understanding as to how we want to look at the bigger picture from the equity markets perspective and just positioning in terms of sectors and what we see from valuations and just a general outlook. So before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we will discuss during today's session. So we'll start off by taking a look at a 2021 review. Hasn't been from an equity market perspective, has been a great year. Obviously not a great year for other things in this particular year. So we'll want to take a look at what our expectations are for next year. And from that, we're going to take a look at both from a technical perspective, what the indicators currently show us from the overall markets, as well as from a fundamental perspective, from a valuations perspective. How does that influence our views going into next year? And then we're going to take a look at some of the sectors that we think are going to do quite well next year, given the current indicators that we'll take a look at, and which sectors we would generally want to stay away from. So let's go ahead and get started. But the primary question that I want to help investors walk away from today is a clear understanding as to what should we expect from markets in 2022 and how should we generally position for that. Now, before we jump into it, how many of you are ending 2021, reducing some of your equity holdings or equity positions? Please type 1 into the chat window if you're reducing some of your holdings going into next year or concerned about a bit of a pullback here. Okay, I see a lot of ones. And some people say you're doing it for taxes. Some people say that you're reducing because you're concerned about the markets. So I want to discuss first, before we jump into what our expectations are for next year, let's first take a look back at what we have seen this previous year. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we'll take a look at both technicals and fundamentals that drive our views and how we want to position here for next year. So let's first take a look at the S&P 500. We had a very good year on the S&P 500, 25% return year to date so far on the S&P 500. If you look at the overall chart, it is pretty much a straight line here to the upside. We had a bit of a hiccup here towards the end of August or so, but we're pretty much ending the year near all-time highs, or basically potentially ending the year at all-time highs. So the S&P 500, great year. And this is one of the few years where we have seen the NASDAQ 100 basically not outperform the S&P 500. The NASDAQ is up 26% in that same period of time. So NASDAQ basically giving us the same performance as the S&P 500. But the one thing about the NASDAQ is that the NASDAQ is far more volatile. So you are getting more risk for not any more in terms of return. So on a risk-adjusted return perspective, the S&P 500 has been the better performing index here for the year. And when we look at the Russell 2000, this is a pretty dismal year for the Russell 2000. Pretty much since day 3 or 4 of the year, as you can see, the Russell 2000 has largely made zero progress here. Net, it's up about 12% from January 1st to right now. So half the return of the S&P 500 and the NASDAQ 100. So small caps severely underperformed this year. Mega cap, if you will, the S&P 500 or broad-based index, really providing the best exposure here for this particular year. And if we take a look at volatility this year, when we look at the VIX this year, really the 2 big spikes that we have seen in the VIX have largely been due to COVID. And this is actually, when we look back to, for those of you that have been with us for a full year, we look back at, the same session that I did a year ago on 2020 review and what our expectations were for 2021. We saw that during that session, we talked about how in 2021, our biggest concerns around volatility, around risk, were with the new spikes in COVID. And if you look at the volatility chart from this year, the 2 major spikes have been because of COVID. So those risks were true, and those were truly the only real risks that we saw to the market here this year. Now, these vol spikes were relatively small in the grand scheme of things, and they didn't last very long. So equity markets, while sold off heavily for a short period of time, a matter of days or to a week or so, they quickly recovered from those levels. And that is largely, what we have seen here for this particular year. So looking at the 2022 technical outlook, this is really when we take a look at the technical outlook here. There are quite a few positives, but also, in my opinion, some major risks that I see here when I look at the technical picture of the equity markets. We have a few different, I would say, indicators that are providing what we would call contrarian bullish signals, and those are the VIX 3-month to VIX ratio, as well as the put call ratio. I'll show you a chart as to what that looks like, and just overall momentum still remains positive. So, those are the general positives, and I'll show you, because when we look at the chart, it'll make a little bit more sense. But there are some major risks here that I see here from a technical perspective. First, we're fairly late in a bullish cycle. Indicators are starting to look stretched. So while momentum remains positive, we have started to see some divergence on those momentum indicators. That is usually some level of concern, especially considering how stretched we see the equity markets. If you look at a monthly chart, we've never had equity markets this stretched away from their moving averages. And when things get that stretched, there's always the concern that you have some form of consolidation or some form of pullback. And the second thing that really kind of across the board that we see are the market breadth indicators. They have largely across the board have failed to confirm the new highs that we're currently seeing here in the equity markets. And that is kind of the under the surface indicators, if you will, that as technicians we really look at to confirm whether a bullish market will likely continue or to see some form of a top. And we're seeing a lot of that here towards the end of 2021. And that is some of the concerns that I see going into next year. And lastly, just a financial conditions index. This is really looking at, how when we refer to financial conditions, we're largely talking about how accommodative the Fed is. We're starting to see that come down. We see tapering. We know tapering is coming. We know interest rates hikes are coming. Those are things that have very strong correlations to equities. And unfortunately, they've already diverged away from where equities are currently trading. So those are some of the concerns, the major concerns that I see here going into next year. So let's just start with the positives here. So, we look at the VIX 3-month to VIX ratio. And when we look at the VIX 3-month to VIX ratio, what we're looking for is when markets get stressed and they recover from that. So when the VIX 3-month to VIX ratio goes below 0, we consider markets to be stressed. Markets are fearful. When the front month of the VIX is higher than the back month VIX, that's when markets are showing signs of stress. And when that stress level recovers, those are generally good periods of bullish markets. So we've seen that multiple times here since 2020. Every single time the stress index triggers below 1 and recovers from that level, those have been great buying opportunities. And we recently just saw this one here at the beginning of December. Now, the question is, does this start a new bullish opportunity here in the broader markets? Well, the signal was relatively recent and certainly can point to further upside. So this is one indicator that is positive. The other one is really put-call ratio. We haven't seen put-call ratios at this level for quite some time, since November of 2020. So remember, during the election of 2020, this is when we saw one of the largest, strong runs here in the broader markets. The last time we saw this, the put call ratios that were this high, was after the sell-off during the pandemic, which also was followed by what was a large rally here in the equity markets. Well, we just got another reading here in the put call ratio above 1. And this is, again, another possibility where, as a contrarian indicator, when markets are fearful, that usually provides buying opportunities. So that's what the VIX 3-month ratio and the put call ratio both provide. These were times when the markets got a little too fearful. And once that subsides, they become buying opportunities. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. So, these are two signals that have generated a buy signal recently that could lead us to see further upside here in equities. However, that's really where in my opinion, a lot of the positives here, or the signals that we've seen here from a technical perspective, end. And then when we look at some of the other stuff, this is really where it starts to look less rosy. One is inflation. Inflation is really one of the a huge negative here for the S&P 500. Specifically, when we look at CPI, which is the inflation index, when year over year it rises above 6.3, we recently got a print of 6.8. When we look at every single time that the inflation print has rose above 6.3, the average 3-month, 6-month, 9-month, and 12-month return on the S&P 500 have all been negative. So, and if you look at the percentage of times when the S&P 500 was up after those prints, as you can see, very rarely, actually only 40% of the time in 3 months is the S&P up, and only 20% of the time at 6, 9, and 12 months is the S&P 500 up. So when you look at the high amount of inflation that we've seen here in the broader markets, that, historically speaking, has not presented itself to be a good environment for the S&P 500 going forward. So this is one of the major indicators that I'm paying attention to, that inflation, and the evidence shows, regardless of whether inflation is transitory or not, meaning whether this inflation number is a quick spike and comes right back down, or it's a very long withstanding inflation. In both conditions, the S&P 500 going out 3, 6, 9, and 12 months have been very poor in terms of return, and the chances of the S&P 500 being up during those times have been historically very, very low, compared to, roughly 60% of the time we expect the markets to drift higher. So inflation is a big concern here going into 2022 with respect to the S&P 500 returns. Does that make sense? Please type 3 into the chat window if that makes sense to you. Perfect. And this is then where we start to take a look at some of the fundamentals. And when we look at the fundamentals, this is really where we start to see a lot of parallels to what we saw back in 1999 and 2000. Some of you have started your careers or traded your through those times. Some of you are much younger, myself included, who was not trading or investing at that particular time. But for those of you that have been through it, you remember how serious it was in terms of a sell-off. You also remember some of the conditions, perhaps, that drove equity valuations to such extremes before the 1999-2000 tech bubble. But when we look at some of the fundamentals, there are some things that bring parallels to what we've seen. First of all, the percentage of stocks that have negative earnings and negative EBITDA now is actually higher than what we saw during the 1999-2000 tech bubble. And for those of you that may not remember or may not have been around for this, there is one distinct difference between the tech bubble and now. The tech bubble was driven by a lot of companies that had no revenue, not that these companies were not profitable, but you had companies that were listed with zero revenue trading at just ridiculous valuations. I think the market has really learned their lesson on that front. We no longer assign ridiculous valuations to companies with no revenue, even though I will say there are some exceptions, and we've seen some of that this year. And I've noted quite a few of them, of companies that just have no revenue, but were commanding ridiculous valuations, like Quantum Scape, the solid state battery company. You have quite a few other companies that are established and we think are going to generate a fair amount of revenue in the future, that are also trading at fairly ridiculous valuations, like some of the some of the cruise operators. So we've learned our lesson from 2000 in terms of no longer assigning generally value to companies that have no revenue, but what we have exceeded what we saw during the tech bubble is assigning ridiculous valuations to companies that are not profitable. And the number of companies that are not profitable these days, 57% of all IPOs this year had negative EBITDA. 70% of them had negative earnings. And this is even worse for SPAC names. And SPAC names is really where we saw a lot of the excess in the market. 75% of SPAC names have negative EBITDA. 87% of them have negative earnings. This really shows me that we haven't quite learned our lesson, or this is the second lesson that we need to learn. The first lesson was don't assign value to companies that make zero revenue. Now, unfortunately, right now we're assigning ridiculous valuations to types of companies that are not making money and are actually losing lots and lots of money. So this, in my opinion, is one of the biggest risks that I see to the current equity valuations that we're seeing here in the broader markets. So this is something that I think is drawing a parallel to 2000 that we really need to pay attention to. So when you look at your portfolio, looking at your companies that you hold in your portfolio, look at which companies are making money and which ones don't. And that's going to help you, in my opinion, navigate 2022, especially when you look at valuations right now. The average S&P 500 stock has a normalized PE ratio of 28 times earnings. That is pretty much a significant premium to the average that we've seen here over the past 30 years or 35 years or so, which is an average of just shy of 20 times earnings. Right now, we're trading at 28. Now, I will say that this is below the peak that we saw here during the dot-com boom, which peaked at around 34 times earnings. But the one thing that I think is important is that with this type of valuation that we're currently seeing, around 28 times earnings, if we look at history going back to 1987, granted the sample size is relatively small, but the average 10-year return of the S&P 500 is negative when valuations are this high. So this is something that's really important for us to keep an eye out for, meaning when valuations were this high, above 28 times earnings, going out 10 years, the performance of the equity market was negative. And this is the first time we've seen this since 2000, where the expected return of the S&P 500 for the next 10 years is negative because of the current valuations that we're trading in. This doesn't mean that next year we're going to see a correction. It just means that going out 10 years, the upside here is far more limited compared to the downside based on history. Now, can history get more stretched? Absolutely. This could perhaps go back to 34 and go to 36 and 38 before it pops, if you will. And that is really kind of the biggest thing that no one can predict, is just because valuations are stretched doesn't mean that they have to come back down. They can continue to get stretched and even more stretched beyond the extremes that we've seen here in the past before kind of that bubble burst. So that's really the one thing that you need to take with a grain of salt with this type of valuation analysis. So taking a look at some of that fundamental outlook here, a lot of parallels here to 2000. One thing that also is concerning to me is just how concentrated the S&P 500 currently is. When 2000 was around, the technology bubble, tech was 35% of the S&P 500, which was the largest it had ever been prior to the tech bubble. Today, that stands at 42%. So 42% of the market cap of the S&P 500 is in one single sector, technology. We've squeezed energy down to 3-4% right now, and technology has a significant outsized weight in the S&P 500. And when you have such concentration, that's really also where you bring more risks here. And like I said before, right now we're trading at 28 times earnings, which is significantly higher than average, but it is below the peak that we saw during the 2000 tech bubble. And we talked about negative EBITDA and negative earnings. For me, this is a huge red flag to the valuations that we're assigning to companies, because ultimately you invest in the company because that company can return profits back to you. You're investing in the future profits of a company. And if a company doesn't make profits and doesn't have visibility or runway to making profits, that's a concern to me. And just based on the number of companies, 75% and 87% of SPACs have negative EBITDA and earnings. And this is really where a lot of the retail flow has been following. That's concerning to me when that large percentage of stocks, which is even worse than we saw back in 2000, are have negative earnings and EBITDA. So that's how I'm currently looking at this valuation framework going into next year. And I hope this makes sense, everyone. So please type 4 into the chat window if that makes sense to you. Perfect. So let's take a look at some of the sectors that I think are worthwhile to pay attention to here for next year. And some of them may surprise you, but the top of the list this year is actually energy. And energy is really a sector that has underperformed the S&P 500 for the better part of a decade. And, we talked about, back in 2019, before the pandemic, of peak oil. We talked about the fact that you've seen this huge move towards renewables. We've covered renewables a lot here in 2020 and 2021. And we genuinely believe in that revolution, if you will, towards green energy. We've had 8 out of the 10 G10 or 9 out of the 10 G10 countries that have committed to zero emissions by 2050 or 2060. You would think of that as a huge fundamental shift for green energy. Yet the oil stocks is really where we still at the moment see a significant confluence of opportunity here for 2022. And this really comes down to a few things. One, energy is the #1 sector when it comes to correlation to an inflation hedge. So when inflation is high, energy shares tend to outperform. And it really has to do with the fact that oil or energy as a sector is heavily correlated to oil prices. And when things are priced in dollars, and which oils or crude oil is, as oil prices climb, energy companies climb as well in relation to that. So especially when we're expecting inflation to run hot for quite some time, and at least for 2022, energy is the #1 sector that screens fairly well or screens best for that hedge against that inflation. It also screens very well on a few other factors. One, from a valuations perspective. Energy shares are trading at a fairly significant discount to the S&P 500 and relative to itself. We see strong EPS revisions, so we actually see earnings growth pretty much across the board, and analysts are revising those earnings higher than they previously were. So when analysts are revising expectations for earnings going forward, and you combine that with momentum, these are really 3 things that align fairly well here for energy shares going into 2022. And just simply the fact that oil prices have remained elevated, whether you want to look at that from a demand perspective or from a constraint on supply perspective, it doesn't really matter. If oil prices remain high, that's going to provide a fairly strong tailwind for energy shares. So I didn't think that I would be, talking about energy, to be perfectly honest, in this, given the fact that how strongly we were moving towards renewables, and just kind of seeing that energy was a sector that had been underperforming the market for 10 years, that it was clear the direction it was heading in. Now, given 2022, we've seen a huge reversal here for energy. And I think, however you like to invest, and some of you may not want to put fossil fuels in your portfolio because you don't believe in the theme. You might want to shift towards renewables. I think despite that view, that doesn't take away from the fact that I think energy may outperform here in 2022. Does that make sense? Please type 5 into the chat window if that makes sense to you. The second, perfect. Okay, I see a lot of 5s. The second sector that I think is worth paying attention to here for 2022 is healthcare. And healthcare, if you look at it from a valuations perspective across the entire spectrum of S&P 500 sectors, this is the one sector that is trading at the largest discount to the S&P 500. It's trading at a relative 20% discount to the S&P 500. So, just from a valuations perspective, it makes sense to take a look at. It is relatively inexpensive valuations perspective, and it has, EPS growth that is actually on par with the S&P 500. So you're getting the same EPS growth. You're basically seeing the same earnings growth as the S&P 500, yet it trades at a 20% relative discount to the market. And this is a sector that has underperformed the S&P 500 by 15% since the start of 2020. So this relative underperformance is always something that I am concerned about when I'm looking at an individual sector. But this underperformance, in my opinion, is actually what creates this opportunity. If you didn't have the underperformance, you wouldn't have a sector trading at a relative discount, and you wouldn't have a sector that is trading relatively cheap from a valuations perspective, despite the fact that it has fundamentals that are just as strong as the S&P 500 itself. So you can pick some specific names within the healthcare. If you look at the top names like United Healthcare, Johnson & Johnson, Pfizer, those are the names that have largely underperformed here towards the end of this year. My expectation is that will continue here going into 2022. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. And the last sector that I think is worth paying attention to here for 2022 are financials. One, it comes straight down to rising interest rates. I covered this on my CNBC trade last week with Bank of America. Rising interest rates are going to benefit the financial sector. It trades at a relative it doesn't trade at a significant discount to the S&P 500, but it's certainly not overvalued by any stretch. It's trading on par with the S&P 500 in terms of valuations. But it does trade at a fairly significant discount relative to itself, especially when you consider the earnings growth that we've seen out of the banks over the past few years. We've seen strong earnings growth that has outpaced a lot of other sectors, yet it trades at a significant discount to those other sectors here at the moment. And those are all things I think align very well here for financials, because you have a sector that's relatively defensive, meaning it has low volatility. It's actually the lowest volatility sector with the exception of real estate. So if you're looking for safety, especially going to what could be a volatile year or concerns about a pullback here, you want to find some safety. And this is really where I think you're going to find some safety here from financials. You have healthy balance sheets across the banks, and you have this quality type factor that's going to provide defensive protection if you do see some bit of a pullback, and at the same time is going to likely get a tailwind from the rising interest rate environment that we do expect the Fed will provide here for next year. So financials really at the top of my list here. And these three sectors kind of round out, in my opinion, kind of the different exposures that you can get to the market. Energy providing more of that riskier sector that will provide significant outperformance if we do see oil prices start to rise. Financials providing some protection, and healthcare sitting somewhere in the middle with respect to risk and reward. So these three sectors providing a nice balance here in terms of concentration for potential opportunities here for 2022. Does that make sense? Please type 7 into the chat window if that makes sense to you. Perfect. Okay, then let's now talk a little bit about some of the sectors that I think are likely going to underperform, and sectors that I think are not where I want to put too much attention on. And this is based on our research and based on partially my personal opinion. But consumer discretionary, consumer staples, these are two sectors that, generally speaking, I think are worth staying away from, especially when you look at consumer discretionary. This is by far one of the most stretched valuations by across the board, regardless of what type of valuation metric you use, like price to book, forward to PE ratios, enterprise value to sales. Doesn't matter which valuation metric you use, they are pretty much anywhere from 25 to 68% overvalued relative to the S&P 500. So this is a sector that has performed very well, but going forward, trying to find individual names or hoping that this one sector will continue in that trajectory feels less likely. And this is also the sector that's most sensitive to rising labor costs and inflation, both things that are huge problems here in the current economic environment that we are facing going into 2022. So a sector that's sensitive to these rising costs, I think, is one that is going to provide a headwind rather than a tailwind for. But I do think that within the consumer discretionary space, for those of you that are stock pickers, I would much rather look at picking individual names within the consumer discretionary name. There are still some names that are just absolutely bulletproof in this particular space. that could provide some opportunities here for 2022. But I think you want to be a stock picker in this particular space rather than looking at buying consumer discretionary as a whole sector. Does that make sense? Please type 8 into the chat window if that makes sense to you. Perfect. And lastly, let's take a look at consumer staples. Consumer staples is really one of those sectors that right now, going into 2022, expecting, more of a reopening in terms of our economy, not just, domestic, but globally. This is really one of the sectors that is least interesting to me because reopening, generally speaking, will hurt staples. We're likely to spend more on services rather than goods when things reopen. I know we've gone kind of a bit back into lockdown here, so as we go back into reopening, that's really where I think staples will fail to thrive in that type of environment. Even though it's relatively inexpensive from a valuations perspective, and it actually shows one of the strongest from a fundamental perspective, I unfortunately still think despite that, cheap valuations don't make up for the fact that growth going forward is likely going to slow down. And we see a deceleration in growth in this particular sector. That's really where I think the upside here is fairly limited versus the downside. It is the one sector that is most hated by active investors. So if you look at hedge funds, if you look at active funds, relative to the S&P 500's weighting for consumer staples, active funds have a 40% underweight of this particular sector. And I think partially for this particular reason, that going into next year, the expectations is that consumer staples will likely underperform here as we reopen, as people spend more on travel, as people spend more on services, and not so much on toilet paper and toothpaste and some of the things that we still need goods for and that we may have stocked up on while we were in lockdown. So these are some of the things that I'm currently looking at for 2022. Does that make sense? Please type 9 into the chat window if that makes sense to you. Perfect. Okay, so out of what we've looked at here today, when we look at the technical picture, from my perspective, there are some huge risks going into next year. Looking at kind of where we see momentum and the kind of the exhaustion that we're starting to see here in the broader markets, there are a few, I would say, contrarian buy signals that have been triggered here over the past month or so that could give you a boost into the early next year. But when we look at the full year, we look at the technical picture, things look a little challenged here for next year. When we look at the valuations and the fundamentals perspective, there's no getting away from the fact that valuations are stretched and they're fairly extreme. I will caveat that with the fact that stretched valuations don't mean that they can't get more stretched. That is one thing that can very well happen. But I think it's important to understand, based on those stretched valuations, just how limited the upside currently can be. And with that information, I think it's important to keep into context inflation, because that is the one metric that I think it's difficult to get away from and difficult to take with a grain of salt, if you will, because historically speaking, that inflation number has been the nail in the coffin for S&P 500 returns going out for the next 12 months. And we've recently just had a print of CPI above 6.3. That historically, going back to 1921, is a huge negative here for the S&P 500. So with those things in mind, I really think that it's important to pick your sectors and pick your stocks really carefully here for next year. Energy certainly ranks at the top. Financials providing more defensive in a rising interest rate environment, taking advantage of some of that inflation, and at the same time, staying away from some of the most interest rate sensitive sectors, consumer discretionary, consumer staples. Technology, while sensitive to interest rates, does have strong earnings power, and many of them are, especially the big names in tech, are very profitable. So the concerns around profitability are not really there for the big tech names, which largely, if you look at XLK, is mostly comprised of those big tech names that are profitable. So for those reasons, we're not underweight tech. Otherwise, I think we would be underweight tech, but I do think specifically within tech, the names that are not profitable, the names that are trading at ridiculous valuations relative to their growth numbers, those are the ones that you do want to stay away from in a high inflationary environment. So with that, that covers what I wanted to share with you here today. I really want to thank those of you that are joining me this late into the year, right before the holidays, to listen and still stay with us on a Thursday afternoon before the holidays to understand how we're viewing the markets and thinking about next year. I hope that this was useful in giving you some value into the end of this year and thinking about how you want to position your portfolio for next year. So with that, thank you so much for all of our members this year for supporting us and allowing us to continue to do this day in and day out, sending you trade signals, sending you our opportunities. So for those of you that are new and you want to learn more, you can sign up for a free 30-day trial at OptionsPlay.com. And just wanted to say a big thank you to everyone. And I hope everyone has a healthy, happy, and a safe holiday with your family and a happy new year. And I will see everyone here in the new year, hopefully refreshed and ready to hit the ground running for 2022. We have a lot of exciting things to launch in 2022. We have a phone app coming out for mobile and Android and iPhone. We have a brand new platform that's ready to go here towards the end of this year that we're rolling out. And we have some fantastic additions to the OptionsPlay team to launch around January and February that will bring more education, bring more trade ideas to everyone. And I cannot wait to announce those things at the beginning of next year. So with that, what I'll do is I'll try to end this with a few minutes for Q&A and give you some ideas, as an opportunity to ask some questions regarding some of the things that we discussed here today before I turn this off here for this year and let everyone get back to your holiday weekend. So there's a Q&A section and a chat section. So please type your questions in the Q&A section, and I will try to answer as many questions as I have time for here today. Has there been a year in modern history that had inflation over 6.1% going into midterm election year? I actually don't know the stats for the intersection of those two. I don't think that would be very common. First of all, midterm election year, meaning the second year of a presidential election from a seasonality perspective, is a relatively poor year. So when you think about a presidential 4-year cycle, the first year and the last year are two, generally speaking, some of the strongest years. The second year, his seasonally perspective, is one of the weakest years. So when you compare, so even though I don't know the numbers for when you look at when both have occurred, when you look at them separately, high inflation and midterm election year, both seasonally speaking are not strong years. So for those reasons, from a seasonality perspective, 2022 doesn't look particularly strong. But again, seasonality, you really have to take it with a big grain of salt, but that's what the seasonality analysis looks like. Is there a site where you can find all the companies that are under the SPAC? Peter, I'm sure there is. I don't know of one, but I would say this is really where you turn to Google. I cannot believe that there isn't a website dedicated to that. Will biotech top healthcare in general in 2022? Biotech, if you look at XHB or XBI, IBB or XHB as the biotech ETFs, both have severely underperformed here in 2021. It's getting to the point where it almost looks so bad that it looks good. So, valuations certainly have come down substantially on this front, but that's partially because I think valuations got too stretched. So I do think for those of you that are looking for opportunities within healthcare, biotech certainly is one place that I would look. Biotech has done relatively well, especially the big names. They've generated a lot of cash this year. That's likely going to bring, some quite a bit of M&A activity here in 2022 from the smaller players, bigger players buying up some of the smaller players. So I expect 2022 to be a fairly active year in terms of mergers. We've seen a lot towards the end of this year. I think that's going to continue into next year. Yes, this is recorded. We'll send you both the slides and the recording here as soon as we're done here today. Are we expecting, again, a big correction before the first interest rate increase in June 2022? So Jeffrey, from my perspective, the communication around the interest rate hike has been fairly consistent and clear to us. That I don't expect a taper tantrum. So for those reasons, I don't necessarily expect you're going to see this big sell-off here, in my opinion. Can you make stock recommendations? So we are going to start off 2022 with some of those opportunities that we see here for next year. This was meant to be more of a high-level overview of the broader markets from a technical and fundamental picture. We will start 2022 with some individual stocks. So yes, that is coming. And yes, this video will be posted on YouTube. If I own stocks that are down a lot, is it better to take losses now or hold them next year and hope that it gets better? Daniel, that is the question only you can answer. And it really depends on how much pain you're willing to take. And more importantly, think not so much in terms of losses. Think about the opportunity cost, right? Stocks that are underperforming may continue to underperform. So are you better off with that capital stuck in a stock that's underperforming, or are you better selling off that stock and buying stocks that are outperforming the broader markets? I always feel that when a stock is underperforming, it's better to reallocate that stock into a stock that's, either back into the market or back into stocks that I think will outperform or currently outperforming. That's my view. Not everyone shares that view. Not everyone wants to take a loss for tax purposes, for other purposes, but my view is when you have a stock that's underperforming, instead of holding it, hoping that you're going to make your money back, you're probably better reallocating that cash somewhere else that's going to give you better opportunities. Will we get credit reports, et cetera, next week? So Arvind, all of the reports run, as long as the markets are open. So because the markets are open next week, yes, you will get all cover call, short put, credit spread reports, straddle reports. All of those will continue to run here next week, despite the fact that we're not running any live events. So how would you be trading the indices in energy, healthcare, and financials, or still hunt for best of breed in each? So Tom, from my perspective, I always think that it's best to get exposure to the broad sector through one of those ETFs, but at the same time, pick some best of breed. That's kind of why I picked Bank of America as best of breed from financials, yet I still have broad exposure to financials through XLF or KRE. So I think having having both is important, not necessarily just sticking to one. Are you planning any additional hedges to your portfolio? I've certainly personally taken, quite a bit of profits here in my equity portfolio and taken quite a bit of profits off the table. I'm not buying protection, but I think taking profits is a form of protection. So while I'm not outright buying puts, I certainly have seats on protection in my portfolio. I think I heard you, but could you just reiterate your highest conviction sectors? Well, energy, healthcare, and financials. Those are the highest conviction sectors. And you can go back and watch the recording as to me breaking down the reasons as to why. Everyone talks about year-over-year inflation. What's the average inflation over, say, the past 3 years? Good question, Ken. I'd like to know the answer to that question, but I don't have that off the top of my head. Thoughts on dividend aristocrats or value stocks? Value stocks are trading at the largest discount relative to growth stocks since basically the tech bubble. So I certainly think that even though we said the same thing last year and we haven't seen value stocks outperform growth stocks, they haven't really underperformed growth stocks that much this year, but they did underperform a little bit. I certainly think that there is more room, if you will, for value stocks than growth stocks going forward because of the relative imbalance in valuations for value stocks relative to growth stocks. Dividend aristocrats, the thing about the S&P 500 is that despite the dividend aristocrats, the S&P 500 has gotten more and more sensitive to interest rates because of how low the dividend yield actually is now on the S&P 500. If you look at dividend aristocrats, I don't know the numbers specifically for the dividend aristocrats, but I would imagine that the average yield on those stocks have come down a little bit more, or have come down quite a bit here over the past few years. And that simply means that these stocks are just going to be more volatile. So for me, I would prefer value over dividend. thank you so much to everyone that wished me and my family a happy holiday. Thank you so much, and again to all of you as well. Will global and emerging markets growth will global/emerging markets growth impact North America? I think the biggest impact here for North America is less so emerging markets, but probably more so China, and kind of what we start to see out of China. We've seen a lot of systemic risk out of China with the real estate sector. I don't necessarily think that that's all flushed out. And just the contagion risk around that particular sector and what that means for valuations in China and how that might spill over to our equity market. So I don't think that that story is done, and I think that will likely bring some risk here in 2022. Any thoughts on fintech specifically? I think fintech is a pretty wide industry that's hard to generalize. I think if you could be a little bit more specific, if you're looking at PayPal, I think that's a little different than other forms of fintech. So if you don't mind being a little bit specific. Do you think most stay-at-home names will go down next year? They haven't done particularly well, so and a lot of them are not particularly profitable, and I think that's really going to be the biggest concern for me, is the fact that none of these really have a strong path to profitability, and likely a less growth in terms of revenue. So for those reasons, I think I would stay generally away from those names. If inflation is in fact transitory and drops sooner than now expected, what are the chances the Fed doesn't do 3 rate hikes in 2022? I would say that is probably the best reason that we see that the Fed doesn't taper as quickly as they think, or don't and hike rates as much as they see. But that's not what we're seeing right now. Inflation is being significantly stickier than the Fed has anticipated, and that's why we've seen this response from the Fed. Other areas of financial besides major banks, just anywhere you have interest rate sensitivity is where I would look. You have a lot of regional banks that are interest rate sensitive, and the major banks like Bank of America and Wells Fargo. Okay, I've tried to answer as many questions as I have time for here today. I really appreciate, again, everyone sticking around here late on Thursday before Christmas. I hope that this was helpful to you and giving you a better understanding as to how we're viewing the broader markets. And with that, again, thank you everyone for your support. I wish everyone here a happy, healthy, and safe holiday with you and your family, and a prosperous new year. And I look forward to kicking off 2022 with all of you back here and looking at what we have to offer here for next year, because there's a lot of exciting things happening for OptionsPlay next year. Thank you so much. Have a great evening, and I will see you guys here in early January of next year. Have a good night.